All right. Um, let's go ahead and first of all, let me see what I had mentioned to you was that I wanted you to take a look at the video from chapter 3, which can be found on Canvas. So if you go to your Canvas homepage, and I warned you it was a large file, but it's listed here under General Course Information. And basically, it walks you through chapter 3, all of the ratio calculations. And as we talked about on Tuesday, we covered chapter 4. I want to make sure that you have a good understanding of not only how to calculate the ratios, but also what they're telling you. That's the key thing when it comes to ratio analysis. I mean, once you work through an example or two, you'll be fine with the numbers. Okay, I'm giving you all of the ratios, all the formulas. You'll have a balance sheet, an income statement. You'll be able to calculate the numbers. But what are the numbers telling you? That's the important thing. So I guess my first question today would be, if you have had a chance to watch this video, do you have any questions about any of the calculations, any part of chapter 3, or really questions about anything else related to the class, the test? I said on Tuesday we're going to review for the test. You voted to have the test on Thursday, so 1 week from today, chapters 1 through 4. All right, so what are we going to talk about today? This was your day, okay? This was your day to ask questions, because if you don't ask questions, then I'm just going to have to pick and choose stuff to talk about. What do I think you need to know for the test? What I would do if I were studying for the test is I would go down to the test information, and then you've got some practice questions here. These are really, really helpful in terms of helping you to decide, at what level do I need to know the material. Okay. Now, for the first test, now here's a study guide also. I would take a very close look at the study guide. Now, what you're going to notice is there's nothing really magical about the study guide. It simply follows what we've done from chapter 1 to chapter 4. But students love study guides. Okay? And so if I don't put it up there, then they're asking, wait a minute, you've always given study guides. Why don't you have one here? So there's nothing magical about it. It's just if you look at your slides and you look at your notes, you will see it pretty much goes step by step, chapter 1 through chapter 4. But it is a good place to start, and it's a good way to sort of focus your studying. There's also a formula sheet. This will be attached to your test. Okay. Now, the test is multiple choice format. We'll talk more about this on Tuesday, but it's going to be 50 questions, multiple choice. And of course, in multiple choice format, you're somewhat limited to the kind of questions you can ask, but don't take it lightly in terms of, it's just multiple choice, so that means it must be really easy. Okay? Because multiple choice questions don't have to be easy. And on Tuesday, when we go through the practice questions, we can take a look at some of those. But, first test with me, first finance test, I would suggest, if anything, over preparation versus under preparation. I always have students after the first test, and they'll say, I should have studied more. I rarely ever have somebody tell me I should have studied less. Okay, so, and another key here is please don't sit down and try to absorb all of this information at one time. It's just too much stuff. It's just too many numbers. It's just not. In chapter 5, which we'll get to next, that's what I sort of call that real finance. We're getting into time value of money. We're getting into using the financial calculators. We're getting into some things that will be really, really helpful and useful to you personally and also professionally. Now, that doesn't diminish the importance of what we covered in chapters 1 through 4. It's just that, when you're looking at financial statements, when you're looking at ratios, you don't want to sit down for a hour after hour binge session on financial ratios. It just doesn't work very well. 30 minutes into it, you're going to be unconscious, okay? So you've got a week. Sit down, look at it for a few minutes, go do something else, come back, look at it for a few minutes, come back. Just break it up. Okay? I promise you will thank me for that, rather than sitting down and trying to just go. I know some classes you can do that. You can sit down, study all night, the night before the test, you're good. And some of you might be able to do it here, but most of you would benefit from breaking it up as you go through the preparation. But again, this is a lot of good information here. Also, let me remind you a couple of things here. Let's see. And I don't have the other information here. For those of you who hung around and listened to the OCC presentation, the Comptroller of the Currency, if you're interested in a really good job and you're a business major, their application window is going to open September 11th, I think, or 12th, and close October 3rd. And the presentation that was given was a really good presentation. Talked about their starting salary, which is about $50,000, the government benefits, the fact that you can work anywhere in the country. And a lot of people hear the term bank examiner, they think, wow, that sounds kind of boring. Actually, as a former bank examiner, it's really not that boring. You spend a lot of time training. The OCC has the opportunity where you have every Friday off. You work 4 10-hour days, Monday through Thursday. You have every Friday off. So there aren't many jobs out there where you get every Friday off. Plus, they're really good in terms of training, throwing you into really important stuff quickly. So if you want a lot of experience really quickly, that would be something to look into, okay, if you are a business major. Also, the Bank Examiner Institute that the Fed is having, which is going to be October 14th, maybe. They are accepting, again, they're still accepting applications, I believe. I'm not sure when it stops, but they're going to be letting us know next week who've been accepted. So if you're interested, then either contact me. I've sent you some emails. Go to those links, apply. It's a really good opportunity. It doesn't cost you anything. You can go up there. If you're not interested after you hear what they have to say, that's fine. You don't have to pursue anything. But if you're interested in an internship or a job after graduation, and again, their pay is about the same. Their training is about the same, and they're one of the top 2, I'd say, the OCC and the Federal Reserve in terms of employers. If you're looking for that type of employment, they're going to be the top 2. The FDIC will be right behind at number 3. And then you get down to your state agencies where the pay is significantly less and the benefits aren't as good. But again, those are really good opportunities. And I have students all the time, they come to me and they say, have you heard about any jobs? Do you know where I can get a job? Do you know where I can work? I'm graduating in December. I'm graduating in May. I don't know how much harder I can push these things towards you and say, these are fantastic opportunities. Look into them, okay? If you get an offer and you don't want to accept it, that's fine. But at least you have practiced your interviewing skills. You've received an offer, which makes you feel pretty good. And then you can do something else if you want to. Or what a lot of people do is they go to work for these agencies for 2 or 3 years, get a ton of really, really good experience, and then financial institutions want to hire you because you have worked for one of these agencies. You know the rules, you know the regulations, you know what to do, and it makes you very, very valuable. So that's one thing when you're talking about your career, as you're going from job to job or different career path to different career path. If you can take some valuable experience from each one of those, that's what you want to do. Because what you're doing is you're trying to simply make yourself more valuable at each stop. If you've got an opportunity to go to a job where there's nothing new to learn, there's no new growth, either professionally or personally, Why do that? Okay? I mean, you're not doing yourself any good. So each step, you're wanting to make yourself more valuable. So just keep that in mind as you progress through your 20s and 30s and 40s and all of that, okay? I promise you that will be a big help to you. All right, so questions? Everybody understands chapter 3. I'm still trying to come to grips with that you have no questions about chapter 3. It's either that or you haven't watched the video yet. Wait a minute, let me pick one of those two. Okay, I will guess the second one, okay? Maybe you haven't watched the video yet. So you're assuming, yes, you know everything about chapter 3. Well, why don't we take a look? Again, I'll just kind of run through this. Now, what I want us to do today is, and some of you do, some of you don't. This may be kind of an issue. And somebody can borrow my book if you want to. But what I want you to spend a few minutes on today is working through problem 24 of chapter 3. You can do this together. You can work on this. You can help each other out. You can share books. You can whatever. Here you go, right here. Here is the book. Do what? And if you get it, if you have a chance, I mean, you can kind of move around to find some people with books or whatever. But I want you to spend a few minutes taking a look at the problem 24. Even if you need a calculator, I can let you borrow a calculator if you would like to. Number 24. Yeah, problem 24, let me borrow this back for just a second, then I'll give it back to you. And actually it's listed, I haven't changed it on Canvas yet, but if you go down to the information, it says here, problem 3-23 from chapter 3. This is actually, and this is the solution, so I'll get to that in just a minute, but this is actually problem 24. So that's the great things they do with new editions of books. You think they've, rewritten everything. Well, they don't. They just change problem 23 to problem 24 and charge you for a new book, okay? So that is problem 24. And it talks about Zach Industries. So what you have here is you have given to you an income statement on page 109 and a balance sheet on page 110. Now, under the balance sheet, you see some ratios. So there is 2014 numbers, and you're calculating the same ratios for 2015. So it's going to be the current ratio, the quick ratio. That's going to be found in the chapter 3 slides. So it walks you through every calculation. And then basically it's simply saying, is this company having problems? If it is, where is it having problems? That type of thing. So again, problem 24. Spend a few minutes. If you have questions about that, I'll be happy to help get you started or help answer your questions. Now, what you'll notice is when you're looking at that problem is that the author of the book, to make it a little more challenging, decided to leave out a few line items. For example, on the balance sheet, you'll notice there are some things missing from the balance sheet that you can calculate. You just have to know what you're doing to calculate those. So as you're working through it, if you have a question, raise your hand. I'll be happy to come to you and help you out. Okay, now what you see here, this is your formula sheet for the test, and so these are going to be most of the ratios that you're working with. This is one page, and then, yes. But I'm going to put these here just in case you would like to use them. Now that may be too, can you see that still? Is that too small? Yeah, same thing.
The same thing?
Mhm.
Okay.
Same thing.
I got a question.
Okay.
My bad.
You're up here by yourself today.
I have a question.
All right.
It's about my job.
I love questions.
It's not about if I have my phone. Yeah, I have it. I have it's like a. I don't know. I forget what the name of it is, but it's like blue calculator. You know the blue ones that I'm talking about.
Is it like a big graphing calculator?
No, it's not a graphic calculator. It's like the step below a graphic calculator. It has all the trig functions, and I can do like a couple of calculus functions.
I don't know. Now there used to be, and I don't know if they're making out a BA35, I think. That won't do what we need it to do in class, okay? But I'll be happy to if you bring your calculator on Tuesday. I mean, for the first test, you just need any calculator, okay? So you'll be fine. But if you'll bring that specific calculator on Tuesday, I'll take a look at it and I can tell you if it'll work or not.
Okay.
For when we get to the chapter 5 stuff.
Awesome. Thank you.
Yes. Uh-huh.
Oh,
I'm
yeah,
a doctor. Yeah.
So, you want this to be at least one, right? Quick ratio.
Typically.
So is this good or bad? Or is
It really
mediocre?
depends on if you compare that to the 2014 numbers and also compare it to the industry average, and you compare it to the industry average, which is how much? Okay. So it's quite a bit higher, so that's pretty good. Typically,
Year round? Should all of this?
that is fine. That's fine. Yeah, two decimal places.
Okay.
Yeah.
Or
So
where? Our final.
now
Oh,
this would be probably going to be 2.33 instead of.
fine. Okay, so that's high. Shoot. So we're making them look better than they are. So they're wrong. They're not that good.
No, you're good. You're okay though. And that's going to be.
Yeah. Test is on Tuesday or Tuesday?
Thursday.
Thursday.
Tuesday we're going to review for the test, and then next Thursday will be the actual test. next Thursday. I'm sorry to keep bothering you. Any questions?
No, I'm just looking it up here.
Man, you got good eyes. I used to be able to see that 20. You guys are working hard back here.
Yeah.
Questions?
I think we're good.
Good? All right.
Is the accounting different?
Why are they different?
Like for this one, for example, for your quick ratio, I would have done cash plus accounts receivable plus short-term investments, but the current liabilities. You only have current assets minus inventory.
Yeah, and typically, if you take a look, for example, at short-term assets, typically they're going to be cash, accounts receivable, short-term investments, and inventory. Okay, so basically, what I said was current assets minus inventory is exactly the same thing as those three added together. It's just they just.
But then I didn't know you divided by inventory on that one. You do not do average, like average.
Yeah, and typically the reason I do that is because sometimes you're just given 1 year's worth of data, and to calculate the average, you either have to be given that number or you have to be given 2 years worth of that, so that you can add them together and divide by 2 to get the average. So, and I'll bring that up actually because typically average is better, but for simplicity's sake, a lot of times I just use the actual number itself. Okay, what they're telling you is not wrong, or it's not. You accountants, you get really into this. Okay. Are there any questions back here on row number 4? You just all having fun? Yeah, look at this. He's smiling. He's having so much fun. Good.
Plus 1.84 divided by 2.
It's going to be the current ratio with the current assets. Current liabilities. It should equal. Okay.
Then we will have a similar like this.
Yes. Like I'll give you a balance sheet, I'll give you an income statement, and maybe ask you to calculate a few of these. And also, what does it mean if it increases? What does it mean if it decreases? What is it saying about the company?
Yeah, so we will also annual formula sheet.
Yes. You'll have that exact sheet. That exact. Okay. Just attached to your test. All right. Okay. Any questions here?
Is interest charges like interest expense?
Yeah. Same thing. You guys got any questions?
Been good so far.
Breezing right through. All right. That's what I like to hear.
Will we take the net profits before taxes and then interest expense?
So times interest earned, what you're going to do is going to be your operating. Okay, take a look at your income statement. You're going to see operating profit, 70,000, divided by your interest expense. And interest expense is going to be found further up with about 6.
And
So 17,000 divided by 6.
why is this one like this? Because it said the total liabilities and total assets. Why is it not?
Can I say it again?
Is that ratio? Is that for this problem? If you take total liabilities and total assets and total liabilities,
This is one of the things I said where they kind of make it more complicated for you. Okay. So if you look at your balance sheet, anywhere there where it says total liabilities.
yeah, it just says total liabilities.
That's going to give you your total.
Okay.
And so that should equal, divided by 150,000,
Okay.
gives you 61.3%. That's part of, that's part of stockholders' equity.
Yeah, what I
That's
thought,
exactly
but I
right.
didn't know why they wouldn't have just put the liabilities.
Now, for test purposes, I would give you, it'll say total liabilities, okay? But they're just trying to do that,
No,
but make it a little more
that-
complicated. Okay.
It'll be on the first page.
Any questions? No? Is going to be also called operating profit. So on there, if you find the line of profit before interest is taken out, before taxes are taken out, it should be listed there. Operating profit, 70,000.
Yes, sir. Yeah. Operating profit. Okay, so EBIT is the same as
Okay. So you're doing the times interest earned ratio? Okay. Do what?
debt ratio supposed to be one, like, because I thought
No. And that's, let me say something because you're the second person to ask that. That's one of the trick things that I mentioned earlier.
stockholders' equity in it.
I'm supposed to subtract that out. Okay, let me say something about one of the ratios. I've had a couple of people ask for the debt ratio. Okay, one thing you need is total liabilities. What you will notice is in problem 24, they don't give you a line item for total liabilities. What they do give you is, and you can get to it a couple different ways, you can take current liabilities plus long-term debt. That'll give you total liabilities. Or you can take stockholders' equity, the total amount of liabilities of stockholders' equity, and you can subtract out the stockholders' equity part of that, which I think is retained earnings and what a common stock. Subtract that out, that'll still give you total liabilities. Okay, so that's one of the line items that I said that they leave out just to make it a little more challenging for you. Now, for test purposes, you will have a complete balance sheet, and it will say total liabilities. Okay, I just wanted to make sure everybody was clear on that whenever you're calculating this particular problem. Does that answer your question? It's going to be, let's see, debt ratio 69 plus 22,950 divided by 150, which is 61.3%.
Well, do you want us to write it as 61.3 or can we leave it at 0.161?
You can do it either way you want to. Now, the way you can look at it is it's either 0.613 or debt is 61.3% of assets, or for every dollar of assets, they have borrowed 61.3 cents.
I was just asking like how you want to arrange for like
Yeah, 0.613. Yeah.
Earnings before net interest taxes is the same as net profit before taxes.
Earnings before interest and taxes, that's going to be the same thing as this, operating profit. Yeah, because operating profit is before they've taken out interest and before they've taken out taxes.
The times ratio for that.
17,000.
So I get that you're doing the EBIT.
EBIT, which is called operating profit.
Yes.
Yes.
Divided by the
Interest.
charges, right? Okay.
Yeah, that's exactly right.
I took the earnings before and I took it divided by the interest expense.
It's going to be operating profit. So it's going to be the $17,000. If you look at the income statement, I'm sorry. Look at the income statement. Go down almost to the bottom of the income statement. Yeah, because that's what the company made before they've taken out interest and before they've taken out taxes. So earnings before interest and taxes is the same thing as operating profit.
Bad. Butterfingers. Thank you.
Okay, I thought it was just before tax.
That's okay. That's what we're doing. That's going to be the same thing. Now this company doesn't preferred stock dividends. So it would be earnings available to common stockholders is equal to net profit after taxes. Net profit after taxes. So if you go to your income statement, it's going to be equal to this amount.
Net profit before taxes.
Net profit after taxes.
Okay.
Yeah.
What is your net income?
What's your net income? That's exactly right. Now, if this company had shares of preferred stock, like the example that in the book, then you would have to subtract preferred stock dividends to come up with earnings available to common stockholders. But since they don't have preferred stock, earnings available to common stockholders on your formula sheet is the same thing as net profit. Okay? Let me get it real quick. I'll be back. Mm-hmm.
What is the interest charges? What do you?
Interest expense.
Okay.
So it'll be on your income statement, and I think it's 6,000 maybe, 6,100. Yeah. So it's going to be EBIT, which is the same thing as operating profit. Yeah. So it'll be 17,000 divided by the 6,100. All multiple choice.
So I saw the practice passed all the cameras. I'm sure it's not only like 20 questions.
Yeah.
So we need to review more.
I would, well, I mean, yeah, I would study more than that, but that's just to give you an idea of the type of questions that'll be asked. Okay? Right. Excuse me.
Okay, how do you do the
Net profit margin.
is that the same as the profit ratio?
Yeah.
Yeah.
Profit margin.
Which would is that and basically that means put after taxes adding back the interest expense and then divide by net sales credit.
It's going to be,
I have net income on here as this, but net income on the previous problem where EBIT was plus tax expense.
yeah, you can see it here, okay? Net profit margin, earning available to common stockholders divided by sales, okay? Now, the example that I went over, company had preferred stock. Okay, so they had to pay preferred stock dividends. So if common stockholders, okay, this so net income or net profit after tax is the very bottom line. So that's going to be
So you're saying net profit after tax is the same as net income?
yes.
Because plus income tax expense plus interest expense.
It is. That's earnings before interest and taxes.
But isn't this EBIT?
No, EBIT
Okay.
operating profit. Because see, operating profit, you haven't taken interest expense out, you haven't taken taxes out. So what? And they're actually taking everything that I'm showing you, and they're actually turning it around. And it's the same thing, but they're saying take this and add back to it, whereas I'm doing the exact same thing. I'm just going the other direction.
Seems like they always make you find the answer versus here it gives you
That's right.
this answer as a whole, and then you go.
Yeah, and that's fine. I mean, it helps you learn it better. But I think it's maybe confusing you a little bit because it's giving you the same number. It's just you're going at it from two different directions. One, you're going down the balance sheet, I mean, the income statement. The other, going up the income statement.
Earnings available for common stockholders. Would that be
Net profit or net income.
so? Would it not be common stock plus retained earnings?
So it's going to be the bottom line of the income statement.
Net profit after tax.
Yep. Yeah, because that's the earnings available that can be paid out to common stockholders. So you can either pay that all out in dividends, you can keep part of it in retained earnings. You can do what you want with it. Okay?
Is common equity the same thing as equity?
It's going to be common equity is going to be those two items added together. It's going to be your common stock plus retained earnings.
And could you, we can't see the end of this last.
Okay. After taxes. Okay, let me give you one other item. When you get the chance to watch the video calculating all of these, you will see that the example in the book, that company has shares of preferred stock. Okay, so when you get down to net profit, then they have to subtract out preferred stock dividends to come up with earnings available to common stockholders. That's if a company does have shares of preferred stock. The company that you're working with now does not have shares of preferred stock. It just has common stock. So in that case, earnings available to common stockholders is the same thing as net profit after taxes, the very bottom line of your income statement. So some people call it net profit after taxes. Sometimes you'll see it as net income, but it's going to be the very bottom line of your income statement. After all expenses have been subtracted, that's how much the company now has available, if it wants to pay out to common stockholders, or it can hang on to it in terms of retained earnings, or it can do a combination. Okay, so remember that. Earnings available to common stockholders, same thing as net profit after taxes. It's going to be common stock plus retained earnings. Those two together.
Stockholders' equity and
It's going to be, for this example, you're going to have to add two items together. You're going to have to add,
retained earnings and common stock, right?
that's right.
Okay.
Yes.
So the common and the stock. I didn't know if common equity and the stockholders' equity were in.
They're the same thing. Yep. The book value is going to be following the, wherever it the market value. Okay, book price, going to add the common stock, the two line items together to come up with total equity divided by the number of shares outstanding, which it has to give you that number in there. So that's what it's worth on the books, okay? The $25 is what it's selling for in the stock market. The book value is going to be equal to, it's going to be the common stock equity or common equity, same thing, which is going to be, on your example, you've got two line items to add together. You've got common equity, I think, and retained earnings. Add those two numbers together, divided by the number of shares outstanding.
Okay. So common stock or common equity plus retained earnings divided by the number of outstanding.
That's right.
I see where it says 3,000 shares, the closest thing was 5,000 shares. So I take the common stock divided by 1,000.
Now, okay, book value is going to be common equity plus retained earnings, total stockholders' equity, divided by the number of shares outstanding. Okay? That'll give you, in terms of the balance sheet, what the stock is worth, the book value. The market value has to be given to you. That's what it's selling for in the stock market. And I think that's 25 maybe.
Yeah, 25, and then the first part you said where it's for the market, the book value is stockholders' equity.
Plus retained earnings.
Yeah, and that's 19.
Divide that by the number of shares outstanding.
Wait,
Divide it by the number of common shares outstanding.
that's what I did. I got 19.
Okay, that's right.
So
That's the book value per share.
Divided by the number of outstanding shares.
Yes. Okay, let's take a few minutes to go over this. I want to make sure I'm getting a lot of questions, which is good, but I want to make sure that everybody has a good understanding of what this is telling you. And then again, let me suggest go back and watch the lecture on chapter 3, because what I do is I go through the example in your book, the income statement, and the balance sheet in your textbook, and I calculate every one of these ratios, and I also talk about them a little bit. So even though it looks like a long, drawn-out video, but you can fast forward through it, you can move through it pretty quickly. But I would really suggest that. But let me go through this just to kind of show you what this is telling us with this company. Now, they don't ask for all of the ratios listed in chapter 3, but they ask for a lot of them, okay? So, for example, the first two are liquidity ratios, so the current ratio and the quick ratio. Now, the current ratio is equal to current assets divided by current liabilities. So it is 1.04. Now, we don't know exactly if that's a good or bad number, but what we can do is we can compare it to 2014 numbers, which is given to you in that little table. We can also compare it to the industry average. And typically, the higher the number, the more liquid the company. Okay? For the quick ratio, we take current assets minus inventory. And the reason we subtract inventory is because inventory is not as liquid as the other types of current assets. So, if you have to sell inventory quickly, you may be stuck with it. You may be stuck with selling it for pennies on the dollar. It's not very liquid. The definition of a liquid asset, and you may see this on the test, a liquid asset is an asset that can be converted into cash quickly without a significant loss of value. okay? And that last part is really important, without a significant loss of value. So inventory doesn't really qualify. So sometimes we want to look at the quick ratio. So that's going to be the 72,000 minus the 45,500 divided by the 69,000, which is 0.38. And again, has it gone up? Has it gone down? How does it compare to the industry average? Now, the inventory turnover. This is basically how many times per year do you go through your inventory. So if, for example, if you sell perishable items, you sell food, fresh food, you're going to have to turn your inventory over a lot, okay? You don't want that sitting on your shelves. Whereas if you sell things that don't spoil, I mean, it shows more activity if you go through your inventory more often, but it's not necessarily going to spoil if you don't sell it. And so that's going to be the 106,000 divided by the 45,500. It means you go through your inventory 2.33 times per year. Again, good or bad, we don't know. You can compare it to 2014 and to the industry average. But typically, the more you turn your inventory over, the better off you are. The average collection period. This is also, and I might have had another name. Let me pull this up here. Okay, same thing. Okay. And so the average collection period is equal to your accounts receivable. So basically what it's saying is how long does it take us to collect money that's owed to us? So if you plug the numbers in, the 25,000 divided by the 438.36, it's going to give you 57.03 days. So that's on average how long it takes us to collect money that's owed to us in our accounts receivable. Again, is it good or bad? We don't really know. If you've got a 30-day collection policy, that's not very good probably. But if you've got a 60-day collection policy, then maybe it's okay. Again, you have to see if it has been increasing, has it been decreasing. But normally you want that number to go down, okay? You want to collect your accounts receivable as soon as possible. Now, to get to this, of course, we had to calculate average sales per day, so we went through these numbers. And again, once you watch the video, I think it'll become a lot more apparent to you. Now, the debt ratio. This is one of them that they kind of complicated a little bit for you. Instead of giving you total liabilities, which is everything the company owes to other people, they gave you a couple of line items. They gave you current liabilities and long-term debt, and you had to add those together, which was the 69,000 plus the 22,950 divided by 150,000. Now, this can be read a couple of different ways. Somebody asked me, they said, well, how do you want this? Do you want it as like 0.613, or do you want it as 61.3%? What this tells you is, and again, think about this, because when you're thinking about these ratios, this is the important thing. What is it telling me? This company has total liabilities of whatever that number is, I don't know, 69,000 plus 22,950, divided by what it owns, total assets of 150,000. So what this tells us is this company has borrowed 61.3% of the value of its assets. Or another way of looking at this is for every $1 of assets, this company has 61.3 cents worth of debt. Now, is that good or bad? We don't really know at this point. But again, the higher the number, the more leverage the company is utilizing. And financial leverage simply means you're borrowing money. Now, borrowing money is not necessarily a bad thing from a corporate standpoint, but what it means is if you, just like with any other type of leverage, if you're profitable, financial leverage increases your profitability. But if you're losing money, financial leverage increases your losses. So you have to be really careful with financial leverage, and again, it talks about that in the video. I see a hand go up somewhere over here.
When you were explaining the 61.3%, the first thing you said, I didn't get the end of your phrasing. This company of 61.3%
of total assets. Yeah, so that's what that's telling you. It's simply total liabilities about total assets. So they have borrowed 61.3% of total assets. And again, the higher the number, the more leverage they're utilizing. The next one, the times interest earned ratio. This is simply a measure of how much cushion does the company have in case something goes wrong, if they have a financial emergency. So what this is EBIT, earnings before interest and taxes. Now, it's not listed as that in your example. It's listed as operating profit. But if you wanted to find that, you could simply go from the bottom of your income statement up, and you could find out, okay, where do they stop before they subtract out interest and before they subtract out taxes. So that's going to be $17,000 divided by the mandatory interest payments. Interest is what the company is paying to use somebody else's money, to borrow money. So that debt that we talked about, that's what they're paying for to use, to borrow money for the debt. If something goes wrong, and let's say the company has some type of financial emergency, they have to come up with a lot of money. What this tells us right now is this company has 2.79 times as much in operating profit as it does in mandatory interest payments. And the reason that we look at interest payments is sometimes certain bills can go unpaid. I mean, people won't like it if they don't get paid, but it's okay. Interest payments are not negotiable. Interest payments have to be paid. If you miss interest payments, typically you're in default of your bond issue or you're in default of your loan terms, and bankruptcy is next. So that's why they're using interest here. Now, what's going to happen is, as this number goes up, the 2.79 times, that means the company has more cushion. So if, let's say, they increase their operating profit to $25,000 and interest stays the same, the number's going to get larger. What that means is if they have a financial emergency, they can pay for that financial emergency and they still have enough money left over to make their mandatory interest payments. Now, think about this. This is the same thing for you. For example, let's see if this thing will work. Let's say, for example, is this going to do anything? Okay, it is. Okay. Let's say, for example, right now, and I'm just going to make up some numbers here, but let's say right now, you have $1,000 in income per month, and you have $1,000 in expenses per month. Basically, this is the same thing as the times interest earned ratio. It's simply saying what happens if you have a financial emergency. So right now, your ratio here is 1.0. If something goes wrong and your expenses increase, you're in trouble. You don't have any room for error. But hopefully, what's going to happen is you're going to survive finance, you're going to graduate, you're going to get a good job, and so let's say that your income increases to $4,000 per month, but your expenses only increase to $2,000 per month. Now you've got a 2 times ratio. So if your expenses, something happens down here, okay, you can still hopefully pay that bill and meet your other obligations. You've got some more breathing room. You've got some more cushion. And if it keeps going up and you don't have what's called lifestyle creep come in, lifestyle creep means that as you make more money, you spend more money. And if you don't think it's true, just kind of look around you at people you might know. Okay? I know some people that were probably better off in college being broke than they are now making $100,000 per year because maybe they're spending now more than they make. Okay? But so if you can let this, keep going, so if your income goes to, $6,000 and your expenses stay the same, you don't feel you need a bigger house or a better boat or a nicer car or whatever, then this goes to 3 times. More breathing room. So that's what this is telling you when we're talking about the times interest earned ratio is simply how many times do they have an operating profit as mandatory interest payments. The higher the number, the more cushion they have. That makes sense? Got how that works? Okay, the gross profit margin. This is simply going to be your gross profit, which is going to be sales or sales revenue. It goes by several different terms, minus cost of goods sold, which is, let's see here, and then you've got your sales number here. So now we can read this a few different ways. We can say this is 0.34, or we can convert 0.34 to a percentage, 34%, which says this company, for every dollar of sales, this company makes a 34% gross profit margin, or for every $1 of sales, this company makes 34 cents in gross profit. Now, is that good or bad? Again, we don't know at this point. For some companies, that might be fantastic. For other companies, that might be a terrible gross profit margin. There are some industries that have really high markups. For example, the furniture industry, the jewelry industry. They have really, really high markups. That's why they can have sales, they have a 70% off sale every week. Well, how do you have a 70% off sale every week unless you really, really mark up the prices initially? Then you can come down 70% and still make a profit. Okay? So you've got gross profit margin, net profit margin. Now, in the example, in the video, I also talk about something called operating profit margin. And operating profit margin falls right in between these two, and it's going to be the operating profit, or the EBIT, divided by sales. Now, we get down to the net profit margin. That's going to be the 6540 divided by 160. So after everything is paid, this company makes 4.1 cents per $1 of sales. 4 cents, 4.1 cents. Now again, that may not sound like a lot, but it depends on the type of industry you're in. If you're in a volume industry, you make your money on selling lots of stuff, lots of dollars worth of stuff, and making that 4.1 cents per dollar. If you're in a less, or an industry that sells fewer items, for example, if you're Boeing and you're making jetliners, among other things, you probably don't sell many jetliners every year. But the ones that you do sell, you make a huge profit margin. So that's the difference. Boeing would have a much higher net profit margin than, say, Walmart, but Walmart makes its money on volume, not on mass profit margin. So just different types of industries. On the right-hand side, you see return on assets. For this company, it's 0.0436 or 4.36%. Again, that could be good or bad. This ROA, and again, I don't know what industry this company's in, but if you are in the banking industry, and that's what I do, that's what I teach, okay? So that's what I know. If you're in the banking industry, what would you estimate would be a good ROA for a bank? Return on assets, percentage-wise. A good one? 4.36? Higher, lower? Okay, a lot of people have mistaken ideas about banks. They think banks make a ton of money. Actually, they don't. If a bank can average, if you're the president of a bank, and you can average a return on assets, ROA, of 1% per year, you will have a job forever. A 1% ROA for a bank is pretty good. Sometimes it'll go up to 1.4, maybe 1.5%, 1.6%, maybe during really good times. Other times it drops down to 0.8%, so less than 1%. So banks make very, very, very little money in terms of their profit or their return on assets. 1%. That's why when people talk about banks and they say, well, banks don't loan money to people who really need to borrow money. Well, that's not true. They do, but you have to have pretty good credit. And the reason is if you have a 1% ROA, you don't have much room for mistake. And if you make just a few bad loans, guess what happens to your profit? It's gone. It's wiped out. So that's why banks have to be conservative and they have to be very careful as to who they loan money to, because if just a few bad loans can completely shut down a small bank. All right, so that's return on assets. Return on equity or return on common equity. That's, again, now I wanted to say something here really quickly. The numerator, if I can highlight the numerator here, okay. On your formula sheet, this is called earnings available to common stockholders. I've mentioned this earlier. I want to make sure you understand this. If a company has shares of preferred stock, there is typically a difference, and they pay preferred stock dividends. There's a difference between net profit and earnings available to common stockholders. That difference is going to be preferred stock dividends. In this example, they don't have shares of preferred stock. So net income or net profit after taxes or net profit, whatever you want to call it, the very bottom line of the income statement is equal to earnings available to common stockholders. They're the same thing, the same number. So when you look at this formula sheet and you see this, okay, earnings available to common stockholders, on the test, I'm trying to think, but I don't think you're going to be dealing with preferred stock. I'll go ahead and tell you this. So this would be the same thing as net profit after taxes. Now, if you do have shares of preferred stock, you just take net profit, subtract out your preferred stock dividends, and you're left with this dollar amount. But I want to make sure that's really, really clear to you as we go forward. Return on equity, this is going to be, again, earnings available to common stockholders. Now, they don't give you total stockholders' equity. They give you two line items, which I think is common stock and retained earnings. Is that right? You have to add those two together. That is total common stockholders' equity. So that's the 31.5 plus the 26.550. So that's 11.3%. Market to book ratio, you have to be given the market price per share, which is $25, okay? So you have to be given that every time. The book ratio, or the book value per share, this is going to be equal to stockholders' equity, which again, we have to add these two together, divided by the number of shares of common stock outstanding, which it tells us is 3,000. So if we add these together, divided by 3,000, the book value, this stock on the books, on the balance sheet, should be worth $19.35 per share. In the market, it's selling for $25 per share. If you want to buy it in the stock market. So this means it's selling at 1.32 times its book value. And what this tells us is the higher the book value compared to the higher the market value compared to the book value, the more excited investors are about the future of this stock, the more they're willing to pay for one share of stock. So as this number gets larger, that means you're paying a higher premium for the stock, but it might be justified because, again, there's a lot of excitement built around this. Now, when this number starts getting down around 1, which means the market value is about the same thing as the book value, or even if it gets less than 1, that means that, let's say this is market to book value is 0.85, which means the market value is 85 cents compared to $1 of book value. At least theoretically, I could buy every share of stock in this company, sell off all of its assets, and make a profit. It's worth more in pieces than it is as a whole company. So in the video, when you watch the recording, it's going to talk about something called a hostile takeover. We talked about that back in chapter 1 also. And when the market to book ratio starts getting down around 1 or less, that's when you're a very good candidate for a hostile takeover. Somebody can come in, buy your company. They're going to kick current management out, which would be you if you're running the company. And they're either going to sell it off in pieces or they're going to bring in their own management to run the company, hopefully more profitably than you have. Because if your market to book ratio gets down to 1 or less, you haven't been doing a good job of maximizing stock price, which is what we said in chapter 1 is what you want to accomplish. You want that stock price as high as possible for bonus reasons, to stay away from hostile takeovers, for whatever reason. Okay, so that's why you want to keep it high. Now, in looking at this, again, what you would do, you can simply go through and kind of compare this to, let me go here really quickly, and I'll show you at the very end of, this is the end of chapter 3, so if you watch the recording, you will actually see this. But you're going to see something like this, and what this simply shows you is, this is for chapter 3, this is every ratio, the formula for every ratio. You've got some historical data here, so 2010, 2011, 2012, so you can do a time series analysis. You can see if they're increasing or decreasing. You've got the industry average, and just some general comments here on, is this doing well, is it doing poorly? So there's really nothing scientific about this. There's no magic number that says if the current ratio is so much greater or less than the industry average, the company's doing good or bad. It's just kind of an acquired art of looking at financial statements, looking at ratios, and trying to determine when they're good or bad or where there's a problem. So if you take a look at our company in chapter 3, what you'll notice is basically the only two places they're having problem are the collection period and the payment period. The collection period is getting longer, which is a bad thing. The payment period, how long it takes us to pay our bills, is getting longer, which is a bad thing. So in looking at this, if I'm trying to decide how am I going to solve this problem, well, I've got a couple of choices. One is I could bring in a highly paid analyst or consultant and say, okay, fix this problem for me. Or maybe we should start with the simplest fix. Think about this. If you're not collecting your money, your accounts receivable, you don't have the cash to pay your bills. But if you run this company, you take a walk down to your accounts receivable department, your collections department, have a talk with the manager of that department and say, hey, what's the problem here? We're not collecting our accounts receivable. Look at these numbers. We need our money in faster. Do you not have enough people working for you? Do you need more resources? Do you just need to work harder? What's the deal? But if you can start getting this number down, the accounts collection period or accounts receivable collection period, if it gets smaller and you're getting your money in sooner, then you can pay your bills faster, and this number is going to come down. So one conversation could solve this entire problem. 15 minutes worth, and you're done. Now, if that doesn't work, you may have to take more drastic action. But that's where I would start. Always start with the simplest solution first. If that doesn't work, you can always complicate things. It's not a problem. You can always throw money at it. Let's start with the simplest solution first. All right, any questions about chapter 3? Okay, so on Tuesday, we'll review for the test, talk about that, and then next Thursday is your test. Everybody have a safe weekend. I will see you back here on Tuesday.